What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your daily dose of the digital asset universe, where the news moves at the speed of light, and we've got another packed show for you today. The market is buzzing, the trends are shifting, and if you're not plugged in, you're missing out. We're diving deep into the seismic shifts that are impacting your portfolio and the future of finance. From massive market events that could send shockwaves through your favorite assets to the very fabric of ownership and security in this new digital age, we're breaking it all down. Get ready for insights that matter, because the only constant in crypto is change, and we're here to keep you ahead of the curve. So buckle up, because you are not going to want to miss what's coming your way. First up, we're talking about a colossal event in the options market that has everyone on the edge of their seats. A situation that could redefine volatility for Bitcoin and Ethereum. Then, we're going to explore the evolving landscape of who actually owns Bitcoin and what that means for everyone, from the biggest institutions to everyday investors. After that, we've got a story about a major legal battle that's just been settled, potentially clearing the air for a prominent industry player and its investors. And finally, we're heading south to El Salvador, where a groundbreaking move is being made to secure national reserves against future threats, a story that highlights the cutting edge of digital asset security. Stay tuned, you won't want to miss a second of this. Make sure to smash that like button, subscribe, and ring that notification bell so you never miss an update. The $15 billion Crypto Options Expiry, a volatility catalyst. The cryptocurrency market is perpetually in motion, and sometimes specific events can act as powerful catalysts, igniting significant price movements and shifting market sentiment. One such event on the horizon is a massive options expiry, pegged at an astonishing $15 billion. This isn't just another date on the calendar. It's a focal point for traders, analysts, and investors alike, all watching to see how this expiration will ripple through the prices of major digital assets like Bitcoin and Ethereum. Options contracts give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. When these contracts expire, the open positions must either be closed, rolled over, or exercised. The sheer volume of $15 billion tied up in these contracts suggests that a substantial amount of capital is in play, and the expiration could lead to increased trading activity and, consequently, heightened volatility. The market often experiences increased price swings around these expiration dates as large players adjust their positions. This can create opportunities for some, but also introduce significant risk for others. The anticipation of this expiry has already begun to influence trading strategies, with many looking to position themselves ahead of the potential market turbulence. The question on everyone's mind is whether this expiry will act as a significant catalyst for price discovery or simply lead to a temporary shakeup before the market finds its next equilibrium. Analysts are scrutinizing the distribution of strike prices and open interest to gauge potential price targets and the direction of the most significant market pressure. The outcome could provide crucial insights into the short-term sentiment and directional bias of the market participants. This event serves as a stark reminder of the dynamic nature of the crypto markets and the complex interplay of derivatives that can influence asset prices. It's a critical moment for traders to stay informed and manage their risk effectively as this significant expiry approaches, potentially setting the stage for dramatic price action. This $15 billion options expiry is a key event to watch, with many anticipating it could spark significant price volatility across the crypto landscape. Now, as we brace for potential market swings, let's shift our focus to something equally fundamental. Who holds the keys to the kingdom of Bitcoin? The scarcity and inequality of Bitcoin ownership in 2025, navigating a constrained market for institutional and retail investors. As we venture further into the digital asset era, understanding the distribution of wealth and ownership within key cryptocurrencies like Bitcoin becomes paramount. In 2025, the narrative around Bitcoin ownership is increasingly shaped by scarcity and a widening gap in inequality, presenting a complex landscape for both institutional behemoths and individual retail investors. Bitcoin, by its very design, has a fixed supply cap of 21 million coins, a fundamental characteristic that underpins its scarcity. However, as more of this supply is mined and enters circulation, the question of who controls these limited assets becomes a critical point of discussion. Current data and projections for 2025 suggest a market where a significant portion of Bitcoin is held by a relatively small number of entities, often referred to as whales. These large holders can exert considerable influence over market dynamics through their trading activities and sheer volume of assets. For institutional investors, navigating this constrained market means contending with the high demand and the potential for significant capital deployment to acquire meaningful stakes. They must also consider the regulatory environment, the evolving infrastructure for digital asset custody, and the macroeconomic factors that influence their investment decisions. The pursuit of Bitcoin as a store of value or a hedge against inflation drives institutional interest. But the limited supply means that acquiring large quantities can be challenging and costly. On the other hand, retail investors face their own set of hurdles. While the accessibility of Bitcoin has increased, the rising price, driven in part by institutional demand and the inherent scarcity, can make it difficult for smaller investors to accumulate significant amounts. This creates a perception of inequality, where those who invested earlier or have larger capital bases can acquire more Bitcoin, potentially widening the wealth gap within the crypto community. Strategies for retail investors in a constrained market often revolve around dollar-cost averaging, focusing on long-term accumulation, and leveraging decentralized finance, DeFi opportunities where available. However, the influence of large holders remains a persistent factor, with whale movements capable of triggering short-term price volatility that can disproportionately affect smaller, less capitalized investors. The scarcity model of Bitcoin, while a key selling point for its value proposition, inherently leads to a concentration of ownership over time. As the market matures and more capital flows in, this concentration is likely to become even more pronounced, making the dynamics of scarcity and inequality central themes for anyone involved in the Bitcoin ecosystem in 2025 and beyond. The ongoing debate centers on whether this concentration is a natural outcome of a scarce digital asset or a potential vulnerability that could impact Bitcoin's long-term adoption and decentralization goals. The concentration of Bitcoin ownership poses significant questions about market fairness and accessibility for all types of investors. As we digest the complexities of Bitcoin's ownership structure, a different kind of battle has just concluded, with a major lawsuit being dropped, potentially reshaping perceptions for a key industry firm. Strategy dodges troubling lawsuit as investors drop class action alleging Bitcoin Treasury misled them. In a significant development that could bring clarity to a high-profile firm and its dealings within the cryptocurrency space, a class action lawsuit has been dropped. The legal challenge, which alleged that the firm misled investors regarding its Bitcoin strategy, has been dismissed, marking a pivotal moment for the company and its stakeholders. This case centered on claims that investors were provided with inaccurate or incomplete information concerning the firm's approach to managing its Bitcoin treasury. Such allegations, if proven, could have far-reaching implications, impacting investor confidence, regulatory scrutiny, and the firm's operational future. The core of the lawsuit revolved around the firm's disclosures and communications about its Bitcoin holdings and the strategies employed to manage this digital asset, which is known for its inherent volatility. Investors who participated in the class action claimed they were deceived into believing their investments were protected or managed in a way that did not align with the actual risks involved, particularly during periods of market downturn. The legal proceedings likely involved a deep dive into financial statements, marketing materials, and internal communications to ascertain the veracity of the claims. The firm, in its defense, would have likely argued that its disclosures were transparent and that the inherent risks of Bitcoin were adequately communicated to all parties involved. The dismissal of the lawsuit suggests that either a settlement has been reached, or the plaintiffs found insufficient grounds to continue pursuing the case after further examination of evidence. This outcome is a significant reprieve for the company, allowing it to move forward without the cloud of this legal battle hanging over its operations. It also potentially signals a robust defense or a favorable interpretation of the facts by the court or the parties involved. The resolution of such disputes is crucial for maintaining trust and stability within the financial markets, especially in the rapidly evolving digital asset sector, where regulatory frameworks are still developing. The firm can now refocus its energy on its core business strategies and investor relations, aiming to rebuild or reinforce confidence following this period of legal uncertainty. The case serves as a reminder of the legal and compliance challenges that companies operating with significant digital asset exposure must navigate. It highlights the importance of clear, consistent, and transparent communication with investors regarding the risks and strategies associated with volatile assets like Bitcoin. This lawsuit's dismissal offers a crucial win for the company, potentially restoring investor confidence and allowing a return to strategic focus. With one legal chapter closed, we now turn our attention to a nation securing its digital future, making a bold move to protect its Bitcoin reserves against emerging technological threats. El Salvador secures $678 M Bitcoin reserve in 14 wallets to guard against quantum hacking threat. In a move that underscores a forward-thinking approach to digital asset security, El Salvador has proactively fortified its national Bitcoin reserves by distributing approximately $678 million worth of BTC across 14 distinct wallet addresses. This strategic redistribution, totaling 6,274 Bitcoin, is a significant step designed to mitigate risks associated with future technological advancements, particularly the looming threat of quantum computing. Until this recent action, El Salvador's entire Bitcoin holdings were consolidated into a single wallet address. While this provided a high degree of transparency, it also presented a theoretical vulnerability. In the world of cryptocurrency, the security of digital assets hinges on robust cryptographic principles, primarily public key cryptography. The process of signing a Bitcoin transaction involves revealing a public key on the blockchain. A sufficiently powerful quantum computer, if developed, could potentially exploit weaknesses in current encryption standards to derive the private key from the public key, thereby gaining unauthorized access to the funds. Although current quantum computing capabilities are far from posing an immediate threat, reports suggest no quantum computer can yet crack even a 3-bit key, let alone Bitcoin's 256-bit encryption standard. The long-term risk is a serious consideration for nations holding substantial digital assets. By dividing its reserve into 14 separate wallets, with each holding a maximum of 500 BTC, El Salvador is effectively creating a more resilient security posture. This multi-wallet strategy reduces the potential impact of a successful quantum attack, as even if one wallet were compromised, the majority of the nation's reserves would remain secure. This approach aligns with best practices in cryptocurrency custody, enhancing both security and operational flexibility. The National Bitcoin Office, ONBTC, has affirmed that this new system bolsters security and transparency, adhering to contemporary standards for managing digital assets. This initiative positions El Salvador as a leader among sovereign nations in proactively addressing emerging cybersecurity threats to digital wealth. It's a clear signal that the country is not only embracing Bitcoin as a financial tool, but also taking rigorous measures to safeguard its holdings against potential future vulnerabilities. This proactive stance is crucial in an era where the very foundations of digital security are being reevaluated in light of rapid technological progress. While some industry figures, like Michael Saylor, have previously downplayed the immediacy of quantum threats, arguing that protocol upgrades can adapt, El Salvador's decision reflects a more cautious and comprehensive risk management strategy. The move acknowledges that while the threat may not be imminent, preparedness is key in protecting national digital assets. This strategic move by El Salvador sets a new benchmark for national digital asset security in the face of evolving technological landscapes. El Salvador's bold security measures are truly impressive, but what does this mean for the broader market? We'll discuss that and more right after this. And that's a wrap on today's Bitcoin Bulletin. We covered a massive $15 billion crypto options expiry that could shake up the market, dove into the growing scarcity and inequality of Bitcoin ownership in 2025, saw a major lawsuit dropped against a Bitcoin treasury firm, and explored El Salvador's cutting-edge strategy to secure its Bitcoin reserves against quantum threats. Don't miss out on any of these crucial updates. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto insights, and ring that notification bell to stay ahead of the curve. Also, make sure to follow us on all our social platforms for more real-time updates and discussions. We'll see you back here tomorrow.